3, 2, 1.
Alright, so hi guys, welcome back to the channel. So today I'm going to be sort of expanding a little bit more on some of the stuff I do here with market profile and why it is a pivotal part of the way I like to look at markets and how I like to do things. So here we're looking at a chart of the S&P 500. We're coming into the Fed release today. And one of the things I was looking at was the bids that were stacking up here, right? Obviously, because again, we can see that we had a slightly higher close. So we opened and closed a little bit higher. So we had a lot of big stacks against the prior week. And as we opened, we could see that gap in value, which we tend to find. And, you know, once we sort of open, you know, to the upside, we have this low liquidity area, we tend to form a gap in value. That's what we call a gap in value. So again, we traded into that gap, and then we also traded the entire value area. Now, of course, one of the things that I was saying at the time is that whenever we're value perception's higher and we start trading into value, we can expect that there's going to be at very least a knee-jerk response as we reach the lower end of value. And of course, there are reasons for this, and I discussed this in a couple of my programs around market profile on why we get this knee-jerk reaction. But we had that knee-jerk reaction. So again, this was a good place to be long the S&P. Now, not to say, of course, that we won't trade out this K period print. Now, we're coming into the Fed, and one of the things that I suppose everyone is paying attention to now is what's going to happen next. Now, again, some of the stuff that I do talk about and I do teach is that you want to first get some kind of structure. So you want to build a structural perspective, right? So that means that you would use maybe a standard candlestick chart and build a market structure where you can sort of deduce on the macro picture, because this is a weekly profile. So each profile is 1 week. So on the macro picture, you can see where the S&P 500 is going to be in the next week, right? Or in the next couple of weeks. So again, if we're bullish long term, so over the next couple of months, then we want to be executing against the weekly profiles. So let's take a classic example. Let's say you were long the S&P at 492 at the value low, and you were looking at risk, for example, just below the prior week lows, right? So we do have some responsive buying here. So again, any trading out of these areas could potentially lead to margin calls, and then we just get a cascade as market rolls a lot lower. And then obviously the next stop will be the next bid stack at 3990, around about that sort of region, 3975. So if we were looking at this as our range, right, we want to see how many points that is. So that's about 48 points, right? So you're looking at about 48 points on the S&P. And where are we looking to go? Well, if we break to the upside, for example, we're likely going to tear up this week, close a lot higher, and then we might see some big breakouts on the Fed. So there's a lot of high volatility, right? Now, structurally, there might be a reason for this breakout, but at the moment we're trading from the high. So trade location wise, there'll be a lot of, the attitude will be to be short, right? Now, again, if we do get a dip in when the Fed happens, right? So let me delete these. So if we did get a dip, we would expect to see K period printed out really quickly. And that's the point where you want to stand out of the way, because it probably means we're going to get a big dip. We're probably going to find support and then rebound, right? I wouldn't expect that we're going to get a dip and then go and then continue breaking. The good thing about the profile is you can pretty much see you can pretty much work out what the volatility has been over a couple of weeks. So again, we can see where the major events were. So we can see there was clearly a big event taking place this week. So we had an expanded range. We can see that subsequent weeks after, the volatility kind of tapered off. And then obviously for the past 1, 2, 3, 4, 5 weeks, volatility's flattened out ahead of the Fed. So if we're going to get expanded volatility, we could use this profile as a benchmark, right, of what that volatility could look like. And that's about 234 points. So if we're looking at about 234 points, then we can probably run that top to bottom. Let's say you are a fan of the break, then on average, we're looking at break-in to value low. So this will actually be a really good bid spec, because then that's kind of the expected volatility we're getting to the downside. Now, of course, if we're going to break to the upside, again, if we take it from the absolute low and then we break it to the upside, then again, the expected volatility is 24324, right? So on average, right? So it can be a little bit less, a little bit high. So again, we should expect the market to cool off at that level, and it would just be above the prior couple of weeks highs, right? So this is the kind of sort of picture we want to build on our mind whenever there's a big news event like the Fed coming up, right? So that's the S&P. So again, if you were positioning against the week, then you, say your bias was long the S&P, then this would have been your best trade if you're looking for continuation. Now, assuming, of course, you believe this was the dip, right? Now, of course, if you think there's going to be a bigger dip, similar to what we got 1, 2, 3, 4, 5, 6 weeks worth of a downside move, then we can factor that in over the next week to two as being trading down to the downside and then rebounding off this level, right? So for me, it's a strong level, and that's where I'd want to be long again, the S&P, right? So of course, again, there are a couple of things to bear in mind here. We've mentioned trade location as being not so great if you look at it from how many weeks we've been going to the upside. But again, these are equities, right? So we can see that we can push 1, 2, 3, 4, 5, 6, 7 weeks of upside. We can push significant upside with these. So again, 1, 2, 3, 4, 5, 6, roughly 7 weeks of upside, right? So again, if we're going to get that dip, it will be now. And then obviously we'll see an increase in volatility back to the downside. If we keep going up, then it will be the longest we've had a bull run since, if we go back to the start of this one here, just click on here, look at the week, and that takes us all the way back to the 1st of January, right? So it'll be the biggest bull run we've seen since January, right? So in terms of distance, right, traveled, and it will be the longest since January as well. So that would obviously also tell me that there's a change in the overall sentiment, right? If we're willing to keep the bull market going that long, then it's definitely a change in sentiment. And that means that we might see it go for another couple of weeks, and then we will get a dip again, right? So just some of the things that we probably want to bear in mind as we sort of go into the Fed later on today. The other assets are mimicking something similar. We did talk about the bull run in gold, for example. And again, you can see that build up here, but we're still within the sort of 3-week value. So there's really reasonable resistance here. Again, with gold, we can get a lot of volatility. I would expect that if we start trading up the upside again and then pushing, then look for responses as we break into that 2K mark. Right, so gold does look very strong structurally as well. It's looking like we've got one more break to the upside before we can see gold going back down again. Again, any surprises from the Fed that leads to dollar strength, gold becomes a good short as we take out the C period low, in my opinion, which is sort of below value low. So we'd have to break through all of this, in my opinion, and then start cutting lower before this becomes a reasonable short. And I think based on where we are literally going to cut back, in my opinion, into value down here. So it will mimic the S&P. So it will be a very, very big drop. The pound is reflecting something different. It's very similar to the S&P. We've had a bounce at value low, and then we've gone up, retested the highs, and now we're hitting steady, and we're not doing anything. So now we just have to see what the Fed brings in terms of upside. Again, a lot of these assets are bullish versus the dollar, so it's really interesting to see what's going to take place. But, I wanted to run you guys through my thoughts on the profile. So here I'm using the profile to give you guys a very good sort of synopsis of two scenarios, right? So I'm not just looking at the upside, I'm also looking at the downside and where I'm going to react. So one of the benefits of the profile is it allows you to plan ahead in terms of what you wanted to do. Now, I don't obviously only look at the spot index or index futures. I also look at options. And one of the things that you'll find with some of the large cap stocks that have the liquid options you want to trade, they're going to respond a lot to the S&P, some more than others, depending on their weighting to the S&P. So you'd get some stocks obviously going aggressively lower with the S&P, others maybe going somewhat lower or staying flat. So if I'm trying to get involved in an option trade, let's say I'm trying to sell premium, for example, then I'd want to really pay attention to this, because say, for example, we start to trade back down into the Fed meeting, the K period low, and then start to really take it out, then I think I'd want to, if I was trying to sell premium, I want to get out of those, right? Just in case that volatility really peaks, because it would also mean that on a Wednesday, even if I was selling weeklies, I'm not in a good position. It would mean that essentially that market is going to give much higher premiums. We're probably going to expand in volatility, because if you look at historically, we haven't had high volatility for the past couple of weeks. So if we go back to seeing ranges like this, this, and this, then, you know, that volatility, that implied volatility is going to expand, right? So being able to plan as well based on what I'm seeing is also quite crucial, because then I know for a fact that I'm making a good decision. You know, if I'm going to have to sort of roll my options or cover them, you know, get out of them, whatever the case may be, I can do that and then collect premium another week and then sort of make up the difference, right? So again, we'll probably come around to talking about options at some point on the channel, but just staying here with market profile. You know, so that gives me a very good benchmark. So I can look at the S&P in a glance, right? I can see a couple of weeks worth of price action and how the price action is distributed using the profile as a very good benchmark to kind of determine that, right? Obviously, as you watch some of my videos on this channel, as I'm going to be building them in, I'm going to be talking to you a lot about some of the nuances around the profile. And then, of course, if you wanted to have a better in-depth, I have a program on the profile, and I will leave details for those who are interested in getting into it. Especially I'll link to my Discord server, so you guys can pop in and see what it is that we do on the Discord server. Yeah, but that's kind of really what I wanted to share today. You know, in terms of the profile, it's just one of those nimble things that when you're trying to build a picture of what you want to do or what you want to act on, it's kind of cool. The other asset actually that sort of hit my radar was crude oil, which is because commodities tend to work very well with market profiles. So if you're a commodity trader, this is like a godsend. So again, you know, yesterday we were talking about that, you know, in my live room. And one of the things we were talking about was crude oil. Now, I mean, trade location wise, we were heavily down and we were breaking what we call the initial balance, and we were trading into new value. And my immediate instinct is that, well, we got a value trade from here to here, for example, through the profile. So that was 72.43. But then when we took the range into consideration, then this has to be the downside. This is kind of where we're looking for. This is the expansion, right? So you can see here, we don't have, you know, we've done a more negative rotation. So the chances of us flipping out now are very slim, and we're already trading the value here. So at any point in time, we might dip lower, catch 66.87, which honestly speaking, I didn't think we would do this week, and then rebound back to the upside, because I think we're very expanded on oil. So either that will come next week, or we're going to see that this week. And it's one of the reasons why I'm so keen to see the market open today, because it will really give me some ideas in terms of what we're going to see next. But I think oil is at that place where we're going to get a very interesting picture, at least for a short-term long, over the next couple of weeks. So definitely oil will be the one to pay attention to. The dip has been quite aggressive. All right, guys, hope you enjoyed the video. Hit the like button, subscribe to the channel if you would want to see more videos like this, where I talk to you all about market profile and, you know, how that could benefit your trading going forward. Till my next video, guys. Adios.
3, 2, 1.